Over the last couple of years or so, I was looking at a chart yesterday, and I believe something like the majority of the returns are coming from seven businesses now. So
Yeah,
basically, if you are not invested in those seven businesses, then you have a large chance of underperforming.
yeah.
It's a very strange market we're currently in, and the mega cap stocks like Apple, Microsoft, Nvidia, they just seem to continue getting more and more expensive as time passes. So, right now, do you have any advice for investors looking at this current market?
I mean, one is so if I was investing in an index, I would want to do it an equal cap weight index would
Okay.
be way better than the market cap weighted index because there's this self-fulfilling prophecy phenomenon where the bigger proportion of the index the company is, the more of it the index fund need to own,
Mhm.
and that sort of drives valuation. So there's a momentum effect there that you can get rid of by owning an equal cap. Um, but I think that there is a that Robert Schiller is a professor of economics at Harvard. He's also a winner of the Nobel Prize. Exactly what work he won the Nobel Prize for, I don't know. I should know, but he's talked about what does he call it? I think it's something along the lines of narrative epidemiology. So this idea that it's well-known idea that just like diseases can travel and can move from host to host and they can be analyzed as epidemics, those are real epidemics. You can look at ideas, and ideas have an epidemic kind of function to them. And we know for some reason that the people who know more about this than I do can explain that conspiracy theories are particularly viral. They transmit very, very fast between one mind to another. And we know also, which is kind of like very sad for humanity, and there are people who think hard about how to combat this, that bad ideas travel much faster, even if they're not conspiracy theories. They travel much faster than good ideas, and they've done so anyway. So um, when you have something like the S&P and you have a group of companies like the Magnificent Seven, the that small number of companies is driving the majority of news stories, and it drives the majority of news stories, and then people read the news stories and then they can't help it and they go and buy shares of the company, and that contributes to the momentum. So I mean, I in a certain way I'm delighted that there are people who are participating in that. I mean, I'm not happy for them as individuals, and if I got to know them personally I certainly wouldn't be happy, but as a market dynamic that's a really wonderful thing because it leaves whole areas that are unloved and overlooked,
Mhm.
and give opportunities for the rest of us to buy stuff that is real value. I think that if you're a neophyte into the world of investing and you say, well, I need to learn about investing, so I guess I'll open the FT or the Wall Street Journal and start reading about that. The uninitiated is not going to realize the degree to which the news stories that show up there are the news stories that people want to read. What do people want to read? The people companies that are kind of like already got a huge amount of momentum going on with them. And so, a big part of the answer is, especially if you're an individual investor, is you don't have to own the Magnificent Seven. Well, that is what I understand that they're now called. Fang was a word for it previously,
Yep.
but the guy on whose podcast I was, whom I just mentioned, he called it the Magnificent Seven, which I thought was a great word for it. I guess there's now seven of them, and the answer is, look, we have to be clear about what we're up to. Are we in the business of talking about what we own? In which case, yeah, go and own Nvidia, but don't expect to make a lot of money out of it. Or in the business, are we in the business of earning a return? In which case, go and buy something that nobody's talking about, or that everybody hates and are talking about, because you're going to end up doing better. But that requires a different way of coming inbound into the problem. So you know,
Yeah, and
I
the
mean, all I'm sharing is a kind of like a long-winded version of the idea that when the taxi driver's talking to you about Nvidia, it's maybe time to sell your Nvidia shares. You know, and whatever the hell the taxi driver's not talking about, that's what you want to buy. You know,
yeah, if they say, "Oh, real estate looks awful right now," hey, might be a good place to look.
exactly.
Yeah.
Yeah.
There's one company I follow personally, Brookfield. Bruce Flatt,
Yeah.
the CEO of Bruce Flatt, he is a total contrarian value investor. And in the past year, they've been buying up billions of real estate all over the world. So I'm just like, huh, that's definitely interesting.
It's been a very unusually successful company. He's been very specific, as best I can tell, about the kinds of real estate that he buys.
Hmm.
He doesn't buy, he likes the center of constrained cities. He likes cities like London, New York. He's not as mad about cities like Berlin.
Hmm.
Berlin's a wonderful place, but it's not constrained. Wherever you got a skyscraper, there's a lot nearby where you can build another skyscraper. Whereas in places like London, New York, there just ain't no space, which makes it a far more interesting place to be a Bruce Flat, if you like. Um,
Yeah, in your book, you actually said you bought Brookfield Property Group during the
a long
2000,
time ago, yeah, that's right.
yeah,
That's right, I did.
in the financial
And
crisis.
that's right, I did. Um, so there's a group of companies of which Brookfield is a part, and I'm not an investor in any of them, but I think that all three of them. I mean, BlackRock is another one, and BlackRock, Brookfield. I'm blanking on one or two others, but their raw material is capital. It's the strangest thing, but pension funds and sovereign wealth funds produce cash at a prodigious rate, and they need places to put the money. And they're not going to invest with Mr. Little Piddly Guy Spier with 350 million in assets under management, but they will invest with a Brookfield.
Mhm.
And so Brookfield kind of structures the world for these. I mean, another firm is Norges. Norges is the sovereign wealth fund of Norway. They have 1 trillion.
Mhm.
That's 1,000 billion.
Yeah.
Yeah, yeah,
Yeah, it's incredible. But getting back to the S&P discussion, yeah, it's a very interesting time. So as I said, I analyze stocks here on my channel. And for example, I was taking a look at Microsoft, and over the past decade, I was looking at where the returns of that stock have actually come from. And I believe the multiple on the stock has expanded at 15% annually over the past decade, whereas cash flows have grown at 8%. So for me, when I'm looking at that, seeing this large multi-trillion dollar business now
yeah,
trading at 42 times cash flows, which is a 2.2% cash flow yield. I mean,
yeah,
for me, I get so uncomfortable with that because if the
yeah,
majority of the returns have come from multiple expansion over the past decade, how likely is that over the next decade? I don't
yeah.
know.
It's a great point. Having said that, I own shares of Ferrari
Yep.
that trades at a similar multiple,
Hmm.
and there are some people are holding on to their shares of Hermes that trades at an even higher multiple. And the reasoning is that you own an asset that just cannot be recreated. It's like a jewel. So if do I really want to sell my downtown uh, plot of land in the city of London for some piece of warehousing space near to Heathrow Airport?
Hmm.
And the answer is no, not at any price. I live here in Zurich in a rented house. The owner, who's a friend, has no interest in selling the home to me. He's just not going to sell it. He owns a piece of prime real estate in Zurich.
Hmm.
He's done. He doesn't care about what other asset he can buy for the money. He's not looking to sell out. If he doesn't live in the home, his children will live in the home, and meanwhile, it earns decent rental income off people like me. So, you know, so I think you need to think about, in the case of Microsoft, how central is the asset going to be in 10, 20, 30, 40 years' time? I think that in my case, I'm making the bet with Ferrari that it is an asset that will be as central in the future. I mean, they sell not much more than 14,000 cars a year.
Hmm.
Can they go to 20,000 or 25,000? I think they can. And there's always going to be somebody who, rather than own a racehorse, wants to own a race car, and it'll give them more fun than owning a racehorse. And they'll be willing to pay enormous amounts of money for it. I've not ever paid enormous amounts of money for a car like that. I did once 17 years ago, and I haven't done anything since. But um,
So you're saying there's some stocks that you would just simply hold on to forever, no matter what the valuation does.
Well, having said that, I mean, you're taking what I said to its logical conclusion. And so, so I can't say I didn't say it because effectively that's what you're. But when I hear you say that back to me, we have to be aware that there are people like Warren and Coca-Cola, where he's like, not a good idea to own it forever and ever, especially if you can sell it without having to pay the taxes. Or and many of our investors are in tax-free or can don't get a very beneficial tax treatment. So
Mhm.
I, it's a hard one, isn't it?
It's
It's a really,
very
really hard one.
it's very challenging. I recently did a video here on my channel talking about my portfolio, and I was trimming some things down, putting that money into better opportunities that I found. And there's always that combat in the brain of, do I simply just want to own the highest quality stocks, even if they're getting quite expensive, and put those into maybe lower quality stocks, but at a much cheaper valuation? And yeah, it's a tough one because even in the 2000 bubble, the tech bubble, Warren Buffett did not sell his Coca Cola shares when Charlie Munger was urging him to. And then in hindsight, I believe it was in the 2002 letter to shareholders, Berkshire, um, Buffett admitted that that was a mistake and that he did wish he sold Coca Cola. And I believe
Maybe
that
he just wanted to get Charlie Munger off his back.
potentially, yes. But yeah, the stock,
Yeah.
I believe it took 13 years for it to get back to an all time high. It did pay dividends over the time, but when you take a look at the total returns, it was very low for the next
Yeah.
decade.
As was the case with Microsoft during the tech bubble, it took like 17 years for Microsoft.
Yeah.
I think that, my answer to that is that to give oneself a rule that allows us to get into the realm of bowling with bumpers.
Mm-hmm.
And so, for example, I really like the 5% rule of putting 5% of my portfolio into something when I like it. 5% is not going to get me it's not going to make me into one of the world's greatest investors.
Mm-hmm.
But it's incredible insurance against the possibility that I might have been wrong. And so that 5% number is a great number for me. And then if you look on the sell side, so the problem with trimming positions is that you're sort of like you're trimming your weeds. No, you're trimming your roses and watering your weeds,
Mm-hmm.
and you don't want to do that. But if you have something that becomes egregiously overvalued, the example that I have is from William Green's book describing Nick Sleep. I think Nick Sleep, when they shut down Nomad Partners, he took half of his Amazon position and he converted it to cash, So he still got half the position riding. And in my case, during the COVID crisis of 2000, I sold half my Ferrari position. So I left quite a bit of money on the table, given where the share price went since. But I slept far easier.
Mm-hmm. Yeah.
So I think that having those kinds of simple rules, where you kind of allow yourself to just live in the rule, and you know that the rule will carry you through. I wrote an article recently on LinkedIn called "Is your investment strategy reproducible?" And there's this beautiful idea expressed by Luca Delano, who I'm going to meet for the first time later this week in Turin, of all places. So if every night at the casino, there's going to be somebody who's going to put his money on number 18 or whatever the hell else, and he's going to win, and he's going to get 36 times his money, and he's going to look like a genius. And if you and let's just remember that those people who are winning, they make a lot of noise, they make a lot of celebration, they draw our attention, and so it can feel like we're always with the wrong strategy. And so that's part of how casinos work, is that the guys put his chips on the number 18 and it comes up 18 is now cheering away, and somebody walks up to the table and wants to watch what he's doing, and now he's putting his chips on another number, and they're like, I want to win like him, I'm going to do the same thing. If we imagine for a second, and this is an example that Luca Delano gave me, it's just so beautiful. It's like, if you're the croupier, and let's just say you own the casino. Now, in the casino, you're losing quite a bit of the time, and you're not making big bucks ever, because you're just constantly grinding away against these other people. And every round of the roulette table, there's somebody who wins big.
Mm-hmm.
you know. But would you ever swap places with as the casino with the person who won big? No, because their strategy is not reproducible. Their strategy is like they happen to hit the jackpot one time. But as the casino, your strategy is reproducible. So rather than worry, and this is a real long way of saying what I just said, rather than worry about, oh shoot, I left half the money on the table, or I didn't sell too, I sold too soon, or is to say I'm following a rule that I know over time will enable me to succeed, and that's the most important thing. And so my 5% rule is one like that, and the rule. I mean, I think that those rules have worked. I think that actually I need to have a more firm rule in place on selling things that have gone up a lot, even though that will reduce returns. You know?
Interesting.
Yeah. I mean, another thing that one has to get used to is that I have what looks like an extremely imbalanced portfolio.
I was just
And
thinking
that's
that, yeah.
and that's because I'm not selling things and they go up at different rates at different times. And I'm not trying to rebalance. That rebalancing is another way of cutting your plants and watering your weeds. So now it creates a problem from a business management perspective because people coming into the fund are buying an imbalanced portfolio. And in a certain way, they're buying appreciated positions. And so a question arises, well, why the hell should they do that? And so so at least one needs to kind of like warn them and make sure that they know that that's what they're buying into. So.
Absolutely. Okay.
Yeah.
Yeah, that discussion on the casino and having reproducible strategies is very interesting because it's always interesting to me when, let's say someone gets into investing, they go and they buy Nvidia, it goes up 300%, and that is their first investment ever. And then they think, oh, well, investing is easy. This is super replicatable. I can just go buy the next really hyped up stock and make another 300%, and I'm going to be a billionaire.
Yeah. Yeah.
But yeah, it's just that what is actually replicatable versus just kind of getting lucky.
Well, that is getting lucky.
In that case, I would agree with you. In that case, I would definitely agree with you.
Speaking to get lucky, that is very similar to just putting your chips on number 18.
Yeah.
It's like trying to get lucky,
Yeah.
So that is a very clear case. There are less clear cases, but that is a very, very effing clear case of just trying to get lucky. So, thank you for throwing me a low ball,
That one I would agree. But the perspective of the person who may have bought it, they may think that, oh, well, Nvidia wasn't a risky position. And then you get into the conversation of, is risk subjective? It's very interesting. But...
So I think that so one way to look at that, and if you read Luca's book, you'll benefit enormously, and you might find yourself wanting to send it out to all of your subscribers or something, or maybe inviting Luca onto your show, which I'm sure that he'd be happy to do. It depends on your. So was I lucky or smart? And it depends on your sample size. So the larger the sample you have, the more confident you are that you'll. And I never really studied serious statistics, but we're talking here about statistics. If you have a large enough sample, then you can be more and more confident that you were smart, not lucky. But the guy who just has dumb beginner's luck is, the probability that they were skillful is by definition not very high. But I think that what you're pointing out is that there are all these weird feedback loops that happen that we weren't evolved for. So the guy who thinks he's smart is then going to, with extra bravado, pile into something else. And that can happen to Mr. Guy Spier, how long into his fund? Like 13 years into his fund. I'd had a couple of good years, and then I piled into this company Horsehead, thinking now's my time to make a big bet, which didn't work out for me. In fact, it went to zero. It was extremely painful for me. So, God teaches us these lessons when we become too arrogant. But yeah, there is that phenomenon And so the people who I think end up succeeding long term are the people who manage to hold on to a healthy sense of humility despite their successes. And that's not an easy thing to do. They have to be well read, they have to have seen, they have to have listened to, for example, you and me talking about this phenomenon. They have to be constantly asking themselves the question. It's not something you can teach somebody, it's not something you convince them of.
Hmm.
The guy who's just bought Nvidia and thinks he's a genius doesn't really want to listen to you or me. But and yeah, that's just a really tough part of it because there are people who think they're geniuses and then have their heads handed to them, and it's just really hard. Although I have to confess that not in the case of Nvidia, but I did have, in some cases, a certain amount of Schadenfreude for some people who, in the most recent bubble, were not interested in. Thought I looked askance at me with leery eyes because they thought I was dyed in the wool, old-fashioned, and I didn't get these new businesses. And I kind of listened with wonder, but I didn't act.
Hmm.
And they thought I was being ridiculous. And then when they lost a lot of money, or might have lost a lot of money, I don't really know. Because, I mean, there's another phenomenon that I would alert your readers to and alert, or your listeners, viewers, and alert you to, is the very extreme survivorship bias. I'll give you one example of survivorship bias. So, there are all these people who took the vaccine, the COVID vaccine, and they had all these adverse reactions, and they didn't like it, and some people took the vaccine and got COVID. You don't have any people who didn't take the vaccine who had an adverse reaction. They're all fucking dead. Excuse my language. So there's a huge survivorship bias where you just don't. A whole half of the sample is just not there. And that's just kind of the tricks the statistics play with our minds. So there's all of that stuff going on in 1,000 different ways. And there's this famous example that I don't know where it comes from, where they were analyzing planes that came back from bombing missions. And so the way you've nodded means that you can probably explain it better than I can. But the point was that they were reinforcing where they saw that the bullet holes were. But where they needed to reinforce where there were no bullet holes, because all the planes that got taken out didn't come back. And so if it came back despite the bullet holes, that was fine. But what you needed to do was, and I don't remember which part of the plane it was, but the survivorship bias and the fact that you might be analyzing a very, very skewed data set, very, very skewed. And this happens all the freaking time. So, you don't benefit from living in Calgary or anywhere where you don't get invited to cocktail parties. You don't have the survivorship bias of the guy boasting about whatever it is in his stock portfolio that's gone up recently. Basically, if somebody wants to boast to me about how great their investments are, I kind of don't really want to talk stocks with them because it's just not interesting,
I agree.
Yeah, I attended the most amazing conference run by an incredible guy. Chris Bloomstrand is an investor out of St. Louis, Missouri, and he writes the most incredible investor letter that is available for anyone to download. Daniel, you can do endless episodes. He'll be starting to write his annual letter soon, but you do like 10 episodes just on his book, just on his book, just on his annual letters. I'm hoping that he writes a book because it would be a pretty incredible book. And there was a reason why I was going to bring that up, but it just blanked my mind. Like I just had a senior moment there, Daniel.
We were on the topic of survivorship bias.
And he writes a letter. Oh, he writes a great letter. There was somewhere I was taking that thought, and plop, it just disappeared.
That's okay.
Forgive me. Maybe it'll come back. You never know.
Yeah, that's perfectly okay.